Good morning, everyone. Anthony Iser here with another ITPM Flash. Well, there's a lot going on in the world at the moment. We've had assassination attempts. We've had elections in Europe. We've got elections in the US. I want to focus on the fundamentals, though. Fundamentals of the economy and the fundamentals of companies. With the economy at the moment, obviously we've got the Fed front and center, likely to be cutting rates in September according to consensus. I wouldn't be surprised to see if that gets pushed out further, but we'll just have to wait and see. Around these transition points, though, you get a lot of mixed data. We want to have a look at what's going on at the company level and the sector level. Retail sales, pretty mixed across the board. And you've got luxury players like Burberry having massive downgrades, management getting fired, all sorts of issues. So when the rich people in the world are reining in their spending a little bit, we need to be cautious. The middle class as well, reining things back in certain areas, discretionary spending down. Nike, massive misses on earnings, massive misses in terms of the outlook going forward. And we've seen retail sales for restaurants down in June. Now, to me, this is a little bit of a red flag in a sector that's done really well over the last year or so. So there's a couple of stocks that have been massive outperformers. Wingstop and Cava are the two that I've been focused on. And the question is, can that continue or has it gone a little bit too far? When I look at Cava Group, recent listing in the US, what is it, you ask? They're Mediterranean food. As you can see here, they've got 17 billion options if you mix and match from their menu. The customer base, well, these look like 4 AI generated customers. That's what their customer base looks like. That's fine. I'm not saying they're AI generated, but if I said, put 4 guys in a picture with a Mediterranean meal, middle-aged guys at a mainstream restaurant, it's probably the sort of picture that would get spat out. Now, the issue when I look at Wingstop and I look at Cava is really, really strong growth, particularly at the top line. I looked at Wingstop and it seems to have strength the whole way through. You go all the way back a couple of years ago, this was one of my what's on my mind stories that I talked about from the buying side of things. It's continued to be a big performer. And I don't have a strong view on it at this point in time. However, on the other hand, is sitting there with 20% sales growth. So on the surface, that looks pretty good. But at 200 times PE, they're going to need to continue to have 20% sales growth, 30% bottom line growth for years and years and years before they get to a reasonable valuation. Now, from a trading point of view, we tend not to look at valuation too much. But these transition points, it's important to, because one little hiccup on that growth front, and we can see a huge derating coming here. So if we look at the top line, 20% sales growth, sounds great. How are they getting it? They're getting it through store rollouts. They're rolling out a store every week. That's great. We can keep doing that. They've got a lot of cash on the balance sheet, so they can keep driving that forward. But that's expensive growth. What we want to do is take it one step back and say, okay, well, what is the underlying business like? What are the same store sales growth? How's that going? That's a true indication of the consumer interest in its product. When we look at same store sales growth, we see it's 2.3%. Now, inflation, as we know, has been much higher than that. The 2.3% doesn't even cover potential inflation in sales price. In fact, they put prices up, and the product mix that they sold contributed 3.5%. So that tells us that minus 1.2% was the traffic growth in the same store sales over the last year. This was in the last quarterly results. That is a really big red flag, because you can spend all this money, you can roll it out across the country, but if you're not getting same store sales growth in a market like this, then there's issues. And those issues will come to bear as soon as we start to see continued turn in this economic environmental situation. And any sort of downturn is going to hit them pretty hard. So what happens with this sales growth? We get what I would call negative jaws. What we want to see in a company is sales like this. We want to see costs at a lower rate and margins expand. Now, at the moment, their margins are holding in there quite well and expanding slightly. But what happens when that sales growth comes down? Same store sales numbers drop even lower and costs are going up. We see negative jaws, we see margin contraction, and that's what I'm quite worried about with this company. Any little hiccup, we're seeing it in mainstream retail consumer world. Nike's earnings were destroyed in the last quarter. The stock was down 30%. So we're sitting here with a company that's $10 billion market cap. It's trading 220 times next year's earnings. It's got pretty strong growth. Its balance sheet's fine, but it is on a knife's edge. And for that reason, I think there's an opportunity here to put on a trade from the short side of things. What I'm looking at is around this next result, where that same store sales growth disappoints a little bit further. Yes, they might have had more store rollouts, but there's room here to see a couple of things. Same store sales growth down a little bit and margins down a little bit. With inflation coming back, they've got no headroom to put prices up. But we know producer prices are going up. So that's their cost, potential for margin squeeze. But really, for me, this is going to be about the outlook and the same store sales growth. Those results on the 27th of August allow us to set up a great calendar structure. What I'm looking at is $75 puts for August and for September. We're sitting there at the moment. I can look at August. They're about $2.50. The following month after the results, they're about $5.20. But all in all, if I do it in a 2-for-1 ratio, I'm getting a 20% reduction in my exposure in the short term. Now, of course, as the mentees that I deal with, the students who come through the institute knows, we're trading off something here. We're trading off exposure in the short term for more exposure in the long term, or lower costs in the long term. But I'm quite happy to do that, because what I think is going to happen from here is we're going to drift sideways. The market is very volatile with all these big macro issues at the moment. Ideally, I get the full credit on the 75 August, have the results, it disappoints, it steps down, and there the profit flows through. So the things I'm going to be keeping an eye on in the next little while, and the reasons why I like this trade, is further outlook on the macro side of things from competitors in this restaurant space, in the consumer discretionary space. Any macro news that might lead to continued reinforcement of this view. And the other thing, with results just coming through now, we want to see how the market's reacting to earnings results. And at the moment, there's a lot of companies that are beating on the top line, beating on the bottom line, having okay guidance, and they're trading down. That says to me that we're in a market where you're going to get punished pretty hard if you have a disappointing result. I can see less about the result, but more about the outlook, guiding down how that can happen with Cava Group. So there you go. Top down, bottom up, trying to put aside all the big noisy macro things like elections and focus on the underlying. Thanks, take care, I'll talk to you soon.